The Federal Reserve is walking a tightrope. Their goal is to tame inflation without causing a recession. It's a delicate balance. Recently, the Fed has been raising interest rates. This makes borrowing more expensive. The idea is to slow down spending and cool the economy. The Fed is also watching economic data closely. They are looking at things like job growth and consumer spending. Based on this data, they will decide whether to continue raising rates or hit the pause button. Right now, the economy is sending mixed signals. Some parts of the economy, like the job market, are still strong, but there are also signs of weakness. For example, economic growth has slowed down. The Fed is trying to make sense of these mixed signals. They don't want to overreact, but they also don't want to be caught off guard. The year 2007 is still fresh in many people's minds. That's when the housing bubble burst, triggering a financial crisis. Some people are worried that the Fed's actions today could lead to a similar crisis. They argue that the Fed is raising rates too quickly. This could shock the economy and cause a recession. Others point out that the situation today is different from 2007. Banks are in better shape now, and lending standards are tighter. This means the financial system is more resilient. Here's another wrinkle in the story. Businesses are stockpiling inventory. They're worried about things like supply chain disruptions and tariffs. This buildup of inventory could backfire. If demand weakens, businesses may be forced to slash prices to get rid of excess goods. This could lead to deflation, which is a sustained decrease in prices. Deflation sounds good, but it can actually be harmful to the economy. When prices are falling, consumers and businesses may delay purchases. They figure they can get a better deal later. This can create a vicious cycle of falling demand and falling prices. The Fed needs to keep a close eye on this situation. They need to make sure that their fight against inflation doesn't inadvertently trigger a deflationary spiral. The economic outlook is uncertain. There are a lot of moving parts, and it's hard to predict what will happen next. The Fed is facing a difficult task. They need to make decisions based on incomplete information. There's always the risk of a policy error. If the Fed raises rates too much, they could push the economy into a recession. If they don't raise rates enough, inflation could become entrenched. It's a tough balancing act. The best we can hope for is that the Fed can navigate these challenges successfully and guide the economy to a soft landing.